The most dangerous moment is not when a business is weak. It's when it becomes too successful. Because the bigger it gets, the harder it becomes to invest the next dollar well. This is where Buffett is different. He doesn't ask, is the company great? He asks, where does the next dollar go? A great business can have high returns, but a giant business has a different problem. It runs out of high return places to put money. Look at Coca-Cola. It's an amazing brand, but it can't reinvest unlimited capital at high returns. So what does it do? It returns capital, dividends, and buybacks. Now look at Apple. As it scaled, the question became, what can absorb hundreds of billions at high returns? So Apple used a Buffett-style move, massive buybacks, turning the next dollar into higher ownership per share. When great businesses run out of high-return projects, capital must move somewhere else. That decision is the real job of capital allocation. Look at Apple after 2016. The company generated enormous cash, but there were not enough projects large enough to absorb it. So Apple used a different strategy, massive share buybacks, turning excess capital into higher ownership per share. But Buffett often chooses a third option. He holds cash, not because he is afraid to invest, but because cash creates power. Cash gives Berkshire something most investors don't have: optionality, the ability to act when everyone else cannot. During the 2008 financial crisis, most investors were forced to sell. Banks needed capital urgently. Buffett stepped in with cash and secured extraordinary deal terms. When markets collapse, most investors lose capital. But Buffett does something different. He writes the terms. During the 2008 financial crisis, Goldman Sachs needed capital urgently. Buffett invested $5 billion, but not in common stock. Instead, he received preferred shares, paying 10% annual dividends. That alone generated $500 million annually. But Buffett added another layer: warrants, the right to buy $5 billion of Goldman stock at a fixed price. When the market recovered, those warrants generated billions more in profit. The same structure appeared again when Buffett invested $3 billion in General Electric, preferred shares, 10% dividend, plus warrants. This is the hidden mechanism. Crises create forced sellers, banks, funds, and companies desperate for capital. When liquidity disappears, cash becomes pricing power. Buffett calls this the liquidity premium. Buffett doesn't hold cash out of fear. He holds cash to turn crises into opportunities. In calm markets, cash looks lazy. But in crises, cash becomes a weapon. And that raises a new question. Why does Buffett sometimes hold over $100 billion in cash? When does cash become optionality, and when does it become a problem?